because green is rolling.
Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for February 2nd, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But we are going to get into some details on the chart, how things are performing. Markets have what they've done, since we last chatted about them. I kind of want to begin by, actually this week by taking a look at the S&P futures. 15-minute chart up. Actually, let's move over here on the day and let's look at this daily chart. And I tweeted out a similar chart here, or it might have been actually this exact chart. Yeah. With this downward sloping trend line, everybody was talking about this thing, right? In terms of the failure at it, how we rejected at it back in December, came back up here. Lots of jabber about it being a new sell, and now the market is breaking through. Not only have we broken through that trend line, we've gone through 2 months worth of highs. For all intents and purposes, that is a good, indication that we could have a swing going on now that is breaking the downtrend and starting actually a bull trend higher. If you notice the whole way down, right, in this bear trend from 2022 through 2023, we didn't really have any instance except for, this one, where we broke multiple, 2 months worth of highs on a rally. And even this rally, up to 4,300, that was still into trendline resistance, as well as, a 50% retracement short at the time. If you drew from 4,800 highs down to this 36.27 low, there was a resistance zone there that we were talking about, right? So it wasn't like, we were interested in what could happen on the 50% pullback. In fact, 39.75, the 4,000 area got like a nice reaction, but ultimately the bulls gave up and the market broke down to new lows. But now we've come back up and we've seen 50% retracements, 2 steps forward, 1 step back, 2 steps forward, 1 step back, 2 steps forward again here. Now pushing through trendline resistance. It's time to stop ignoring some of these technicals and start thinking about the potential for a move higher now, and stop being a bear and maybe start considering okay, if and how the S&P 500 goes to 5,000, how does it get there? What does it look like, right? At least play that tape forward for yourself, right? For as much as you might be betting on, or playing that tape for how we get back down to 3,400 or 3,000, consider how we can go to 5,000, as well, right? Be objective. All right, so big daily level, the 50% swing from 2,100 up to 4,800. That's the support at 3,480 we see holding. Now we're going through downward sloping trend lines. Everything about this, including the market trading back up to 4,200, the old 50% line, I think we're going to eventually push through it. I think we're going to have a little bit of a fight over the trend here, right? Pullbacks to 4,100 and 4,000 are not out of the question as we're starting to try to break above this trend line. Now, the most bearish thing, though, that can happen is the market gets rejected here very, very rapidly, and we're back below 4,000 and falling back into this range all the way back down to 3,800. That would change, right, my perspective of this uptrend or potential breakout that's happening. Okay, but it wouldn't remove, or I'm sorry, as it stands right now, right, I don't have enough to go on to say that I'm going to pick a top and say that market's rolling over. It's an uptrend to me. Every way we've looked at this over the last couple of months and weeks, really, where we've been a little bit more time to flip that hat and talk about what risk on looks like in these periods of worry, right? We're coming up off of lows. We're breaking out of resistance. Some people are scratching their heads, can't figure out why and how we're rallying. And that's precisely the wall of worry that I kind of talk about on a regular basis that bull markets can climb. Now, that's not enough, of course, to keep a bull market going. There, will be reasons to believe it later, but keep in mind that even the stock market traditionally bottoms about 2 quarters before an economic recession is really signaled. And if that's the case, and we're having a recession now or into one here into 2023, that means the market could have potentially bottomed. But that's all bigger, picture stuff. At least in the near term, we can watch this breakout of a big trend level. Pullbacks into retesting that breakout level now as support would be kind of the swings I'd be looking for. And for, again, progression higher. I think we'll put pressure on 4,300, 4,400 in the S&P eventually here. All right, so risk on. right? In terms of the S&P 500, is that being translated in other markets? One that we can look to is the bond market, right? We would anticipate, the 30 and 10 and 30-year markets, the bonds and notes to be, showing some signs, I think, of a bull market or a rally happening there, right? Coinciding with taper's the wrong word, but the slowing down of interest rate hikes by the Fed, right? This is more, we're not in a period of easing, we're still in a period of tightening. The Fed is still hiking interest rates, but the entire market just spent the last 2 weeks arguing over a 0.25 basis point difference here in what the Fed's going to do. Inflation's still double digits, people. Like we are arguing over peanuts, or drops in a bucket when the problem we have is a torrential downpour. With that being said, we can still look to the bond market to see if it's reflecting, right, those real-time interest rate pricing, and if the bonds are trying to price in a more quantitative Fed, right, a Fed that isn't hiking interest rates as much, and might be considering that they overdid the sell-off in the bond market here over, into September and October when we finally bottomed around that 117 figure. If we overdid it to the downside in that sell-off, pricing higher interest rates than the Fed is currently willing to achieve or going to achieve, the market might need to see some short covering. And I think that's what we've not only seen in the last several weeks since the new year, but a trend that's begun since last October. We're now pushing against this 131 area, 50% retracement of the 145 swing down to 117. It's also bumping into, I believe this is our, let me double check what indicators I have here. Edit studies, the 200-day moving average, perfect, at 132. That's kind of what I thought it was. Coming in at 132. So we're banging up against some big technical reasons that above these levels, right, we might see, funds switch, we might see stops get run, we might see shorts cover. I mean, think of how, short the bond market got here since April of 2020, right? We've fallen, 70 handles here in the 30-year. Without much of a rally. And the rallies we had at times were, 10 handles. We had them twice, at the start of 2021 and then about mid-2022. And now, we've got another subsequent bounce. And honestly, one of the strongest bounces we've seen in the bond market since before the recession, the 2020, peak fear recession, what I refer to as Millennials Black Monday happened. Yeah, Millennial Black Monday. Back in March of 2020 during COVID, when the markets tanked and shit hit the fan, for lack of a better term. We watched oil go negative. I mean, first time for lots of things. But okay, we're setting up in this kind of trend channel higher, right? And we're only heading up into resistance. And by the way, we've been banging against this 132 resistance since December. Something's going to give here. And if we push through that 200-day moving average, we've already built up, in my mind, almost a quarter's worth of, stops above that level. And I think, the rip your face-off rally we could see in the bonds could be, pretty nasty above this threshold. I'm not saying it has to happen, but hey, we've got a kind of a triple top into this area of old inflection. If it doesn't continue to hold as resistance, it's going to very quickly become the cannon fodder for a move higher. And then, we're not really talking about resistance again for another 10 handles to 141 and maybe as high as 154, the full 50% retracement. One thing, though, that doesn't support this thesis right now is the kind of the outside day reversal we had in the gold market to the downside. This is a pretty big fake out breakout to 1975, right? The market said, I don't have the momentum to get to 2000. If we were going to 2000 in gold, I would absolutely be expecting the 30-year to be breaking above 132. There is traditionally a pretty tight correlation between gold and the 30-year. It breaks at times, right, when we have yield inversions and the bonds are doing bonds and the metals are doing metals, but you see a flight to quality trade, right, that occurs in the precious metals that coincides with fixed income products. They represent similar risk management tools to a well-hedged portfolio, but they give almost opposite exposure, right? If you're long precious metals, you're usually a little worried about fiat to some extent. But if you're buying bonds, you're getting into the safest fiat play, you can, right? So moral of the story here, April gold has basically experienced a run up from 1647 all the way up to 1975. So just from the, not even looking at a continuous contract, gold might need a pullback, just in a 2-step forwards, 1-step back. Could have happened. Gold's basically been in a breakout here. There might be a continuation support down around 1911, but below 1911 and certainly below 1900, I think we probably drop towards $18 or 1800. And there, we could talk about, a bigger bottoming process. Looking at, a continuous chart here of gold, you can see those similar levels I got up there. Moving out to the daily chart real quick. We've had an impressive rally off of big 50% longs from 1169 up to highs there at 2089, around the 1624 area. That's where the launching point in October. Market rallied up, busted through 50% shorts against the highs. I immediately, once that happens, draw up, a swing from the lows to highs here. And on a 50% pullback, technically speaking, for my methodology of trading, I'm looking to be a buyer on gold on these dips. So we'll see. 1900 is the first area of support I'm interested in. I'm not putting orders out there. I need to see support happen and maybe, get in on day 2 of a reversal. 1800, I'm also not putting wish orders out there just yet. I need to see a reversal off these levels because a day like today, this type of outside day reversal lower, if it sees follow through tomorrow, that means we're taking our way into that other support. And that's a day where it could break and we could see the market fall apart. Go back in history, gold can have these nasty reversals, from 2080 down to 1880 here in just a couple days when it wants to. There's nothing says it couldn't do something like that here and drop $100, very quickly. So, but I think it's a dip to buy. But I don't see my worry here is that if gold rolls over and the bonds are at their resistance as well, we might be seeing both roll over at once. We'll be getting into the row crops here momentarily. Before we do though, let's close this kind of some of these outside markets here off with crude oil. 15-minute chart here today, probably still a downtrend. Going out to their daily chart here, continuous chart. You can make a case for us finding some kind of bottom or support here down into the 68 area. I can still make a case though for another push lower, but ultimately, we're down into the supportive zone for this market that could, take a swing from this 70 area. If this, we head higher into new highs, we're heading to 160, right? We're a long ways off from that. There's still trendline resistance against the highs that's holding. The next in the series, 50% short from 93.75 down to 69.97 lows. It's kind of traded here a couple times up into 82. That is a downside swing target of 64. So I'm a little concerned we might see just that play out here, and we're certainly against a trendline support that if we don't see the market hold here at 75, below that level, I think we're heading down for a move below 68 here. So I'm almost maybe a little more bearish crude in the near term for another push lower at this point, which, okay, a lot of our commodities and things we're seeing a little bit of a top forming, gold included. We'll see what happens. So, okay, let's take a look at our row crops. Let's get into today's soybean price action. March contract kind of in this ascending wedge, but to me, suggests we could be heading into a burst higher. My only worry, one of my major worries, is that if this ascending wedge does not do much to push above 16 and stay up there, we start to roll over, this could be what we refer to as like an ending diagonal structure. But yeah, we'll cross that bridge when we get there. For all intents and purposes, we're still trying to make higher highs and higher lows, and we can easily break out of resistance and really run. Given the 5% stock to usage ratio we're at, I mean, it doesn't make sense for us to get really bearish soybeans unless we got into a trade war with China or something. But at the same time, it's hard to be super bullish because we're out. We've all seen these prices before, and we've seen what can happen when markets want to turn over. Plus, there's the monstrous crop in South America, right? If that crop makes it to market, no problem. And then we have a perfect planting season and great growing season. Yeah, I can see how this is, these are the highest prices we're going to see for a while. But there's a lot going on, right? There's a lot of ifs there too. 18-day moving average below us here at 1513. The 55-day down at 1488. The 100-day moving above that 200-day moving average. We finally have that golden cross. We are now 8 above the 18-day. 18 days now above the 55-day, above the 100-day, above the 200-day, down at 1454. So beautiful golden cross is all happening for the soybeans. This is now what can accelerate trend following buying. This is what can accelerate, fund buying, is now that all these technicals are aligning. There's really no reason to be a technical short to some extent. And if they all start to cover and get out of shorts along with other longs getting in, you can see how this quickly flips the other way, right? And can become a breakout. Still kind of in this channel and channeling higher. There's definitely supportive trend lines here, but the push above 1550, not much to take us, not much more. We wouldn't need much more to take us to new contract highs around 1577 and really shoot for that $16 mark. Let's see what the 4-hour chart kind of says for us in the March beans. Well, before we do, Novi beans did get a bit of a bigger pullback, right? From the 1220 area of that summertime low to the highs after, we basically pulled 50% back, the 1330 area. 1320, 1315 was the real 50%, but okay, right? We had held support up here August through September above 1300. Novi beans came down and said, no, we do not need to go to beans in the teens again, or take us out of beans in the teens. We should be higher, which means I am expecting November beans now to maybe play some catch up here in the near term. I think this first quarter into the second quarter, I think we could build some carry back into these markets because those old crop, new crop spreads have gotten so darn wide. I mean, we're already at $1.64 in the March to Nove. The July Nove next year or this year is at $1.48 over. I think that is way too wide right now. That's why, if you want to be a buyer in the soybeans with a little less downside volatility, I think that can be done via, the November. And this is where, a synthetic courage call strategy might make sense. If we could somehow get into owning the $13 put, right, using it to either cheapen up margin or, you can even bring that put up higher, but owning a put below and then going long November futures with the idea that we can get out of those November futures at some point and just have a put protection on for the hedge, it makes for a nice future plan. But for right now, if we're buying November soybeans, right, I'm expecting this July Nove spread to walk back off of its highs a little bit. I'm expecting November to go up a little bit faster than July, perhaps, and maybe even walk back. I'm not saying that this spread can't go to $2 this year. It very well might. But I'm saying we'll probably go back to $1.20 to $1 over before going and continuing up there over the next couple months. I could be dead wrong about that, but I'm also not willing to just short the soybeans here, right? So I'm not shorting March here. I'm just using this July Nove spread to say, I think we've gotten a little wide here. I want to be long the beans, so maybe I go long November rather than July or any old crop for that matter. I mean, we can talk about May or March the same way. But you see what I'm saying, right? We've hit an extreme in that calendar spread. So if beans are going to remain bullish and that spread is going to walk off its highs, it means that new crop needs to play a little catch up here. And I think new crop needs to come to the prices we're currently at in old crop. I've said this last week too. I think we need to get to $15 in new crop beans, and that means a $1.30 rally from where we're at. A $1.30 rally, would put us up above the 1660 in new crop. New crop might only get to $16 in that which is a 70-cent rally, which means those spreads could walk back 60 cents off their highs while the market still rallied 70 cents in the new old crop and $1.30 in the old crop or new crop. You know what I mean? Rallying less in March than it would in July, and that's just what I'm reading in the tea leaves, right? And it still gets you long soybeans, but we're trying to do so where there might be other things. And the worst case scenario is if we continue to bull spread and both markets go up, you just make less money on the Novembers. And of course, don't buy November without a reason and a stop. But I think we won't see below 1330 here. We're starting to break above that 18-day moving average now in that November bean here at 1369. We're back above the 200-day now at 1366. So there's a lot of technical reasons we'll see fun, covering and a reversal here. Notice the daily RSI has swung from oversold to neutral territory and now overbought. So Could be a pullback in the near term, but I think we'll stay above 13.50. And generally speaking, this market's trying to get back towards $14, and I think we'll see November soybeans trend higher here and start to lead the way over March or old crop. But we'll see. We'll see. I mean, that's an interesting call I'm making in that regard. It's hard for those listening to those words leave my mouth, honestly, because that spread can get much wider. It's a meal, still a meal-driven rally. Soy meal breaking out to new high here today. We're heading in on that $500 mark. That is incredible. Soy oil starting to creep higher too, off of its lows. But generally speaking, right, these charts don't look similar. Everything about the soybean move right now is in the meal. If meal starts to back off their highs and soybeans need to go higher, we need to see oil get picked off their lows. We've been in a range between 60 and 72, 70 bucks there, and the oil, I'm expecting that range to continue, but look for a move back above this 18-day moving average at 62 to kind of confirm that if it's happening. So it's things to look out for there, but not much I would trade in the meal or the oil right now. I think the outright beans have enough opportunity in them. All right, going down and breaking down now the 4-hour chart for March beans, and then we will get into corn and wheat. Don't worry. Talk a little bit about cotton before we go to, because cotton still doesn't give it up. Pretty incredible. Had every opportunity to break down and reverse there and didn't. All right, pretty ugly looking 4-hour chart. This is as choppy as it gets, but it's a trend channel higher. Every time we moved, 2 steps forward, in this case, it was an 80-cent move higher. Yeah, we pulled back, almost 60, 70 cents, but then we did 2 steps forward, right? And then we pulled back, right? $1.20 there, so we pulled back 60. Now we're, kind of fighting between this resistance area around 1530, the old highs. If we go back, it's, breaking out of the highs of the month. You could talk about a trend line against the high and the high that formed here to start the year. Nevertheless, we're breaking through resistance. We keep putting pressure on resistance. Old support or resistance is now support at $15.05, $15. And that's kind of what the last 24 hours was. It was a 50% pullback from the lows here at 1478. The start of January to the end of January, the start of the month, whatever, the last little swing to the highs at 1543, quick pullback to 1510 holds, and the market today, overnight gapped up, ran a little higher. I would not be able to, I really can't rule out a move back down to 1480 and even 1490, for another gotcha move, but we really would not want to see this market get below 1460 at this point, kind of upward sloping trends and some other the level that's basically been holding. We've been above 1460 now, going all the way back to, for the entire month of January, in fact, right? Going back to almost the start of December. So don't want to see us below there. And that's a wide berth, but this market has been very volatile in these ranges. And I do think we're getting ready and coiling up against this resistance here, 1530, 1540, for the move higher to take us towards $16 that we've been talking about. But really tough to trade. I know we've definitely erred on the side of trying to take 10 to 30 cent gains if and when we have them in soybeans, and honestly getting out, waiting a day or two and reloading has been a very good strategy so far. So March corn.
What are you talking about? It looks like it's ready for a bullish breakout. Is that stock?
But yeah, there's a couple stocks. I think have already broken it. Anyway, all right. March corn. Excuse me.
Well, they always find a way.
March corn breaking above that downward sloping trend line we had from our summertime highs through the October high. And actually today and yesterday have been a test of that broken trend line as, now kind of support. I mean, we both corn and beans can't afford to give up any progress they've made on the charts, right? Like they're both continue to coil up against resistance, and that means that we are also, right, coiling up against support that is etching higher. And eventually one side is going to break. Volatility is cheap, and corn's a good example of a market that is trying to break out, right? But if it can't get the legs above 690, clear $7, well, this is just a market getting exhausted into resistance. And you could say the same thing about soybeans up here at 1530, 1540, right? But both markets look like they are coiling up at those levels. Something's going to give. Something's going to happen. I'm optimistic it could push through, but I don't know what the news or the catalyst is going to be outside of a broader risk on an inflation trade right now. So, it is what it is. 18-day moving average on March corn, 675. 200 days around 675. 100 days around 675. I think 675 is pretty important in the near term. It's pretty much yesterday's low as well. It's the downward sloping trend line that the market has broken above and now testing a support. A lot of good reasons I don't want to see us get down to 670. I don't think it would take much to put corn down to 650 again. And then what? Now you're putting all the pressure on that one supportive trend line. You're below all of our moving averages at that point. And there's a lot of stops that have built up in the market, I think in the 640 area, since December for the whole year of 2023. That's where the year would flip negative, right? And that's not that far off. So, if big funds or big money wanted to come in and like break the back of this market, how much would it really take to convince the rest of the market to follow them in either direction here? Not very much is the point, right? You can make a case how a push up to $7 and above really can accelerate things. Of course, we're worried, there's that concern over South American production just looking better and better by all means. Ted Seifert, our chief market strategist over here, was commenting earlier about how good the Argentinian corn is starting to look. And are we just rallying right into a massive wall of global production for corn is another story here that we can talk about. And a good reason that we might, I'm still cautious, right? We're still talking about this resistance that is there because we haven't broken above it. We keep like etching into it. We keep putting pressure there, but we're a broken record until we step outside of these ranges. And actually, the chart of gold today was a good example of a market that was in a tight range against resistance for a while. It did a very quick burst through it yesterday, and we've reversed that entire move back into that range. That's a pretty bearish, right, outcome here, which is the concern that if we have a quick move higher in both corn or beans, that could be the opposite of capitulation, right? That could be the irrational blow off top that then gets whacked down because commercials come in and say, no, we don't need to be worried about that 5% stock to usage ratio in soybeans. There's enough crop in Brazil. We can just import it all day. And certainly with, you would imagine that the falling US dollar isn't necessarily good for that. Sure, that helps bolster our export markets the further the dollar can fall. But let's not forget the dollar is still very strong. So purchasing power abroad for major commercial interests that want to buy South American crop actually have incentive to do so still. So, how does the dollar fall? Well, trade like that is what helps make it drop too. So it's a double, currency swaps and all that and the dollar can be a double-edged sword, particularly in years where we're still pretty tight on soybeans and we're getting monster crops out of South America, right? If China hasn't bought all of it yet, our 200 million metric ton carryout in beans doesn't look too tight. 1.4 billion bushels in corn doesn't look super tight, particularly if Argentina's crop is now not of concern or as much of a concern as it once was. Anyway, but we're still above most of our moving averages in the corn. Today was, I think, a test of that area as support. If we hold above 675, hold above lows yesterday, let's just call 670, line in the sand. I think we'll, have another run back to test 690, maybe towards 7, and that's going to be the real test of this market's strength, or if the bull's conviction, I believe. So we'll see. But hey, the trend is up until it's not. Even as nasty of a day as today was for corn, we stayed pretty much above all the major moving averages, and it still was a higher high and higher low, even though it was a pretty crap close. in the overnight, we would expect this to completely, get us above 680 very quickly and stay there. If, the assumption I'm making that we're finding a support here and now is true. If that's not true, we could break these levels, find our way to 665 and below there, right? Again, there's not much in the way of technicals that would hold us at this point. And again, there's a big concern about a wall of grain from South America that we have rallied into. And that concern's real, right? Can't discount that. Because seasonally, that can make or break what happens for the next month and a half until we figure out planting in the U.S. and can get into weather markets, right? Because if we don't have a narrative, which a falling dollar and strong exports is a good narrative, but it may not be enough to convince the market we need to go higher. Because again, high prices have a tendency to ration out some of that demand. All right, so wheat prices today a little mixed. It was a day where we started off looking glorious, and then very quickly after the open, in about less than a 20-minute period, completely fell off the highs and ran the lows of the day. It was a similar move to what we saw in gold in that regard, right? We made a new high. The market then fell back into yesterday's range, and actually in some places like the KC wheat got really bearish for a hot second and even took out the prior day's low. Now, where we closed on the wheat, only down 3 cents and pretty much a spinning top or like a doji, made today's price action look very, I hate the word synthetic and I hate the word manipulative, but it was definitely a stop hunt, right? We blew off the top. We took out anyone who was shorting with stops above the highs. We quickly reversed. We took out the low end of this trading range, or the book, so to speak, ran the stops on there, and then came right back into the middle of the range for the day, right? That was just dirty price action designed to proverbially knock out the weak-handed longs or shorts and cause the most pain in the market, right? Let's flip back to the Chicago contract, and we'll get into KC again here. So that downward sloping trend line and that downward sloping trend channel, we could have been breaking above, and arguably the last few days of wheat price action is breaking back above that 750 area. Now holding it as support, 744, 745 here, on tests back into it as support, kind of like corn is doing from a different perspective. The 18-day moving average at 744.5 also there. We are up into overbought territory on the daily time frame, but by all means, this market has a long ways to claw back. 100-day moving average is still above us at 818, and the 200-day up at 892. And right now, resistance coming in at this 55-day moving average, which settled today at 766. So, okay, it's a market that's trying to pick itself up off of lows. It's trying to stand back up. We have a short-term uptrend that can remain intact, I think, while we're above the 744 area and certainly above lows of today around 750. But wheat's got to prove itself, take out the highs, and start a real run towards this $8 figure. Otherwise, this is just a test of resistance and a test of the reversal indicator, so to speak, right? Follow through on these is necessary now. KC wheat, and we will look at the 4-hour charts for KC in Chicago in a sec. KC wheat broke through that trendline resistance and has done a little more damage to the short side. We actually got back towards that January top already and tested above. We're now back above the 55-day and holding that for the last 2 days as old resistance now support at 868. 18-day moving average is down around the 50% retracement from the swing low to high at this point around 850. We are into overbought territory there in the daily RSI, so I'm a little worried we're need a little couple days of sideways to down price action to pull that off a little bit before continuing higher. But again, $8 to Chicago wheat is very similar to the $9 mark here in KC wheat. I think we need to see those levels get really tested here, even if the shorts in the market's going to roll back over. I'd like to see that happen, make us feel a little bit more comfortable. In the 4-hour chart, full 50% retracements. The next in the series, kind of in the downtrend for Chicago wheat. We've tested into the 618 line now. All intents and purposes, that could be a failure of that side of the trend now. So, the first reversal 50% lines I start to draw up from that 712 low to the highs after. We would expect now that 740 area to be supportive, 740 to 730. Well, we know we've got moving averages down there. What did I say? The yeah, the 18-day is down around that area, so we can still see that, we tested as support, even maybe go under it, right, to run stops. They got the weak-handed, and that would probably reset the daily RSI as well. So I'm not, looking for the market to totally roll over and go down to new lows without trying to test this area as a supportive area first, right? But for all intents and purposes, any rally up towards 820 to 840, if we find resistance up there, that could continue, us lower in a big way too. But I see a reason, a technical reason that the market's trying to maybe find its footing is really the moral of the story on wheat, Chicago wheat. That rings even a little bit more true with the KC wheat because full 50% short from its 1030. It already broke its, it's next in the series. It's already reversed a little bit higher. I think we're on our way towards this 920 area. That's a 50% retracement from 1032 high down to the $8 low. I want to see that area get tested. Again, that's a test above $9. Tested for shorts to maybe, come back in, right? I'm not advocating being a seller there. I don't think it will hold, but it's the level to the upside that if you're wanting to be short or you're going to try to sell into a rally technically, there's some other reasons other than that 50% level we're looking at that are there, like the 200-day moving average at $9 and what have you. So, I'm sorry, 100-day moving average at $9 with the 200-day up at $9.65. Either way, we've broken through that downward sloping trend line until we get up to the 920 area as well. KC wheat from the 803 low to the high after the 850 area is going to be its full 50% retracement that I'm going to be looking for. And again, down there, 18-day moving average around 848. But if we were to pull back for a day or two into that area, it's a technical reason to be a buyer down there. And it would also be resetting that daily RSI a little lower. So got a reason to look for maybe a little bit of a pullback and a reversal setup here for the wheat. We'll keep an eye on that. Soybeans and corn, right? We've got a support on corn to watch in the near term. So long as we don't break down into the old range, we're just wedging, trying to, make the next breakout higher happen. And if we see the market trade back to highs and go through, hooray, that trend continues. And the same could be said for soybeans at this time, right? The 1510 lows of yesterday to the 1540 highs that we've had, that's a short-term range that's become important for the last week of price action. Step back for the last month of price action, the 1540 range to 1480 range is important. And everything in between there has just been a chop fest and market consolidation. But hey, we're at a point where the market has a chance to break out of resistance, so we're going to talk about that. If it can't do it and it falls back into the range, we know what to expect, right? We know there's potentially some support around this $15 area, but really we start to sink below 1480 to 1460 is the area that we've been above and supported in the March soybeans since December, and below 1460, that's where I just get, my bull hat would have to come off. You got to be flipped to a bear and think that even a test of $13 could be, in the works. There's other levels on the way down, right, that you would talk about, but like at that point, I would actually be concerned about filling that gap down around 1360, right? So that's a whole dollar move that we can expect if that narrative of downside, right, plays out. And there's a few levels that will start to, the first one will hit, and then, we'll be switching that ideology of a market rolling over as it happens, right? And then of course, alongside those moves, we're going to be looking for the narrative, right, in exports falling apart, in South American production being off the charts, right? The reasons to be bearish would set into. Just like if we break out towards $16, we're going to be looking for the reasons for that narrative of bullishness to continue, because if it's not there, right, if it's not there, we're just going to be price rationing demand. All right, let's move on to our softs. Take a look at cotton here. March cotton. Higher high and higher lows yet again. If you looked at December cotton, really playing catch up here. This is a chart, December cotton, that looks like we're about to try to break out towards 90. I'd like to say March cotton will do the same and continue on, but man, the last few days has just been abysmal. But for the last 3 days, we've been inside of this one prior day of price action. So it is higher highs and higher lows inside these days. Anything below 85, though, we could fall apart and, take us right back down in the range we've been in for March cotton, down towards 80. There's an open gap there around 75. If we go below 85, it's almost like I hope we go down to 75 just to, capitulate, fill a gap, and then give us a room, to rally higher. But above, the highs now at 88.80, and certainly above this 3-day worth of price action, this really tight range we're in. I'm pretty bullish above 87.27 and pretty bearish below 85.30. So we're holding above this 18-day moving average, a market that has coiled up as well, and something's about to give, right? This market needs to either flush out the longs and break lower or break out higher. It shouldn't be sitting still here. And, it in a very real way, I think the last week of price action in all of our grains and our any ag product in general has been this very tightening of a range, and like something's going to give. I think we got a good reason for some of these paths of least resistance to be higher at this time, but we'll see. 200-day moving average up at 95.42 would be the next area I'd be looking for. The 55-day is getting close to a bullish golden crossover, with the 18-day moving average finally moving up above those. So neutral territory here for cotton, has some room to the upside if it wants to do it. But I'm feeling like a little bit of a broken record in this range. But at least, right, we can continue to define the lines and levels of invalidation, right, when things behave this way. And that's the important part of the narrative, right? Because no one's going to be able to forecast or tell you exactly where the market's going 100% of the time. All I'm going to be able to do is objectively look and try to tell you and talk about where the paths of least resistance are going to be, or, if we're tracking prey, we're looking for where that next sign or signal from the prey is on their direction, the footprint in the sand, the bent leaf, the whatever it might be. We're trying to just track those things as they happen and give us clues to what the next steps might be. And if those next steps start to play out, the narrative continues in that direction, right? And we adjust accordingly. If we're wrong, right? If my more bullish consensus here in stocks and cotton and in the row crops, if it's wrong, right? We have some invalidation points and some levels below that we've talked about today that can flip that script. And certainly we can come up with a narrative and fundamentals that can support the argument on either side of the equation here, right? There's reasons to be bullish beans and there's reasons to be bearish beans. And history tells us this time of year, you really need to be, taking into account some of those bearish reasons, right? Especially when prices are good, because sometimes we're staring at the best prices we'll see all year. And if only we knew it then, right? It's of course a very 2020 hindsight, thought, but we'll have the woulda, coulda, shoulda trade at some point. But nevertheless, right? There's ways of managing risk in these bullish environments, or where prices are really good and we want a little bit better, right? That's the narrative we're telling ourselves. There's ways of buying puts, selling calls above to help pay for it. If we're doing it as a true hedge, or if we're in a futures position and we want a way of mitigating risk, in a market that's rallied in our favor. Let's take soybeans, for example. Let's say you've been long soybeans and you're really, really nervous about it, right? Or you've got bushels in the bin that you want to objectively protect at this point. I'm hesitant to just put out a strategy right now on new crop beans, just because I would rather and I think that the best way of doing it is probably to look to buying, puts in July on November or December, they're short dated, calls, and then selling, full dated calls against it, because you could probably almost get for 1-to-1, buying a put at like 580. I think I was looking at them priced today, the 580 July on December put. So it goes off the board and expires in July, but it's off the 580 put in that, or the 580 strike for December against December futures. It's a true new crop contract. It just expires in July. You could get away for like a 24-cent cost buying that put. We're trading at 5.97, I think, at the time in new crop bean or corn. So okay, not bad, but it's only coverage for the next 150 days through July. Turning around and selling, a full dated, and heck, why don't we just look at this real quick? If I'm talking about it, I might as well. show it to you for real. Go out to the full dated December calls, which has 295 days on them. I mean, if you're only trying to bring in 20 cents, you basically forget that. Do it for a 2-cent cost. Sell the $7 call. It's $1.05 above us. If you've done nothing in the bins yet, or with your grain from 2022, if you've done nothing with your sales for 2023, this is a decent way of starting that off. Get a floor in there at $5.80 for a 20-cent cost in the July on December short dated new crop, 141 days, protection, cost you 26 cents. Okay. Or no, I was right, 24 cents here, 23 3/4 there into the end of the day for that 580 put. That's not a bad cost for that put outright, given it's 15 cents away from the money. But you could cheapen up that cost by then utilizing, now the full dated December calls, which, yes, they have 295 days on them. A short call definitely has inherent, unlimited in theory risk in the account. But if you're doing this and structuring it with like an actual basis contract, tying your risk now on those locked bushels to the board, we can now turn around and sell a $7 call and bring in 18 cents. That means that 24-cent cost to own that put protection at 580 between now and July only costs you, the 6 cents difference between the 18 cents you just brought in for $7. And by the way, if we rally to $7, you just made another $1.05, right, from where we are in the price today. But you got to, treat that short $7 call, in my opinion, like a true sale, at that point. And if you're long a future and you're looking for a way to manage the risk on that future, right? This is a way of doing so as well, though, right? You can buy a put, sell a call above. If we rally up to that call strike, well, your future, right, appreciated in that value. But then now, you're probably going to get called away at $7. Well, okay, I would not apologize for that situation because it's $1.05 from here, right, from what you'd be making. In addition to the 18 cents you brought in, and of course spent 24 to get that put protection. But hey, that's a 21-cent total cost or risk from being long the market right now at 5.95 corn, 5.80 put. To own that with this risk reversal or collar strategy costs you 6 cents. So you're all day risking only 21 cents in corn to basically be long December corn for the next 141 days without having to do anything if you wanted to. There's, of course, some management to roll that put up to, lock in additional gains or buy back the short call if, things have dilly-dallied sideways and nothing's really gone anywhere and just time values come off. There's other ways of managing the trade, but for the next 141 days through July, you have a set it and forget it type of trade that if you did nothing and the market fell apart $2, in fact, 580 put kicks in and covers the risk on the long future. Is the idea, right? That's never advisable to not be paying attention to the trading you're doing, but right, the next true action that you have to take is when that July option expires, and that could be true for your hedging strategy too. But without that futures position as just a pure hedge, you want to look at a way of getting protection here for corn. There you go, 6 cents to own a 580 put and get a floor in here for corn. Of course, it involves selling that call in December, but that's part of the strategy. Similarly, in soybeans, right? You can look at a very similar type of strategy. $15. Let's just look at what that looks like here in just March, because a $15 put right now, if we don't want to see the market get below, the way we've consolidated up against this resistance, I think you can use some of these puts as very tight, stop position or stop levels for long futures positions, or for 8 cents here, 9 cents, you can own a $15 put for the next 22 days in the March beans. If you're long a future against that, you could sell a $16 call and still bring in 4.5 cents and cut that cost in half. $16 is 30 or 70 cents higher. you get a put that's 30 cents below us for 4 cents to take profit at $16 if it gets there. Now you're thinking like a trader, how to manage risk. And this is true for if you're trying to hedge bushels, or if you're long futures and you want to find a way to put on a strategy that can help manage risk. These are the types of things that we're always talking about with our clients and working with them to really create the plan that's right for you. Because it's not just where we think the market's going. It's how do we protect either the money we earn, capital we're putting to work, profits we potentially have, or hopefully we don't find ourselves in this situation, but it happens. How do we plug the leaky vessel at times, right? If you've been long wheat and just on the wrong side of a trade, and you don't, or any market, been short soybeans and wrong side of the trade for the last few days, or it could be long and short corn. It's hard to have been on the wrong side of that because we've gone nowhere. But I'm just picking markets, right, that have moved over the last couple of weeks in not just one direction, but have put people underwater for various reasons, right? The idea, though, is that there's ways of working out of those problem spots, too, by using these strategies. At some point, you need to have protection in a get the hell out. Sometimes the best option is just to get out and not try to work your way out of a position. But if you have the time, the capital, and the wherewithal to do so, using a strategy like a risk-reverse strategy, even when times the position's going against us, sometimes we can structure it, to work our way out of it. Let's say we're short from 1480 in soybeans or something, right? And the March contract. We don't want the market to go above 1540 again, right? 1540 calls are costing us 19 cents. Pretty pricey, right? They're almost at the money, but let's say we were willing to give this market to 1550 or something. I don't know, right? We had to stop up there anyway. 15 cents, you could buy that 1550 call to stop the bleeding, so to speak, against a short position in soybeans. If we were short from 1480, I immediately am going to go down and look at the puts at 1480 to see how much money I can bring in to basically have a break even or scratch trade built into me. So now I can turn, obviously the put protection in the worst case scenario here doesn't kick in for another 15 cents at 1550, but even a 1480 put is bringing in 5 cents. So now I'm cutting the cost of owning that put down to 10 cents. I'm giving myself the ability and allowing the market to maybe work its way out for the next 22 days. I know the max I can lose is against that 1550 call now because I'd be short soybeans. And I'm giving the market the chance to get back down to 1480, where if it goes below 1480, I would be very happy at that point of just scratching out of the trade. And really then only having the loss of the cost of putting on that risk reversal strategy. At some point you need to make a decision on how and when to cap risk on any trade, right? But when there's so little time left on the clock, you don't get as much for those short puts. But the idea is you can utilize a risk reversal strategy to help plan your way out of any trade at any time. It's just a means of managing risk and giving yourself a window of opportunity in the marketplace that ultimately we don't know exactly where it's going to go, right? And that's the moral of the story here on today on utilizing these, because in a market where we're trying to hedge and the market price keeps going up, risk reversal strategies end up being a great strategy for a hedger because it builds in that floor in price while keeping the upside open at the same time. So thank you for joining me here today for the Strategy of the Week webinar. I think I continue to reiterate the synopsis that bull markets climb a wall of worry. I think it's a lot truer right now for our risk markets like gold, silver, the S&P bonds, all those types of markets, and even crude oil. There's more seasonal and cyclical things coming in on the row crops, certainly, right? Like we are into South American production season. We're into U.S. export season, so there are tidal shifts going on in row crops and arguments starting to be had over pricing, right? So I don't think they're going to be as jointly, connected to the rest of the risk trade. I mean, obviously, we didn't see much of a response from any of our row crops in the S&P's massive rally in the last few days, right? So that's my point here, is that I think that we're starting to, the row crops are starting to focus more on the row crop things, and so do we. We need to shift our focus and our attention to those too. So That being said, have a great day, everybody. Thanks for joining us for the Strategy of the Week webinar. I'm Dan Hussey from Zaner Ag Hedge. You can always reach me over here at 312-277-0110. Find me on Twitter, Dan SOTD on Facebook, or shoot me an email at dhussey@zaner.com. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.